Good afternoon. My name is Nick Francis, and I serve as Head Portfolio Manager of the JFC Residency Program. We would like to take this opportunity to thank the CFA Board for allowing us to compete in this year's RFP. Our program consists of 5 teams, covering all asset classes, as well as an economics forecasting team. Today we'll be going over our economic forecast, followed by asset allocation and presentations from each asset class. And move on to Haley to discuss our economic forecast.
Thank you, Nick. So for our economic forecast, there are 3 factors that we feel that are most important to look at over the next 12 months. Unemployment, GDP, and inflation. Let's start with unemployment. Unemployment continues to recover from its peak in April of 2020 at 14.8%. In October of this year, it reached a record low since before the pandemic. With the current labor shortage, it has resulted in companies increasing wages, which has caused wage inflation as well as supply shortages. Looking forward into 2022, hospitality, leisure, and retail were the key industries that kept the unemployment rate up, and we believe that these industries will be the industries leading the way to bring the unemployment rate right back down to pre-pandemic levels. Our forecast for the next year is that both unemployment and labor participation will reach pre-pandemic levels at around 3.6% and upwards of 63% respectively. Let's move on to GDP. For GDP, in 2020 it leveled out to negative 3.4%. Moving into Q4 of 2021 and into 2022, consumption is going to be the key factor that we're going to look at. With the supply shortages moving into this holiday season, consumers will be forced to spend their money on something that they wouldn't typically buy, and they will be looking at companies that locally manufacture and do not rely on international suppliers. For 2021 GDP forecast, our conservative estimate is that it will be around 0.75%, and it will continue to recover and increase to 2.5% at the end of 2022. For inflation, inflation continues to be a growing concern with food and gas prices as well as inflation increasing over the last few months. With that being said, contrary to what the Fed is saying, we believe that inflation is not transitory, and our forecast moving into 2022 as the Fed continues its tapering strategy is that inflation will continue to increase and will peak in the middle of 2022, and then will start to recover and decrease towards the end of the year into 2023. And now I'll pass it back to Nick, who will go over asset allocation.
Thank you, Haley. Our investment process begins with an economic forecast. From there, we use an asset allocation model that takes into account portfolio theory as well as our economic forecast. From that point, we task our analysts with finding the most attractive companies in their assigned asset classes. We don't merely use a screener to find companies. Rather, we follow sector-by-sector news to find the most attractive companies in each sector. We then utilize a screening rubrics to determine if the company has a good quality of earnings. Our asset allocation for 2022 looks very similar to last year's, with one key difference. We plan on trimming our fixed income exposure because we find that there are several opportunities in real estate we'd like to invest in. Moving on to our year-to-date performance. Chapman outperformed the benchmark by 245 basis points while taking on less risk. This is evident by our beta of 0.97, our positive Jensen alpha, higher Sharpe ratio, and higher information ratio. Our outperformance can be attributed to our asset allocation as well as our individual security selection. Unique opportunities such as Stamps.com and Copart were major drivers of our returns. I now pass it on to Anthony to discuss fixed income.
Thanks, Nick. Now to discuss the fixed income environment. To start us off with interest rates, we have 2 major developments happening here. The first one being in the short end of the yield curve. We expect the federal funds rate to rise in the next 12 months as the Fed attempts to combat inflation. And then in the long end of the yield curve, we expect bond investors to demand higher nominal rates due to said inflation risk going forward. So where does that leave us with our fixed income strategy as a whole? Well, as these investors demand higher returns, we've actually found quite a few unique investment opportunities. Specifically, short duration, high convexity, adjustable rate securities, and preferreds. And going off to our allocation, you see we're very overweight adjustable rate and preferred stock, with shorter allocations in short maturity and non-investment grade. All of these still fit into short duration, as well as the last one providing us with extra yield as well. So the first pitch for you guys today is the Polo Senior Floating Rate Fund. The fund provides us a broad exposure to the floating rate market, and because these loans are actually very favorable to the lender, it gives us a very strong yield as well as short duration. And going more into the fund overview, their floating rate rather than fixed allows the rates to adjust with the market rate, which again provides us short duration as well as insulation from long-range shifts of the yield curve, which for fixed income specifically is very important as price risk, interest rate risk are at an all-time high. Now I'd like to introduce Colette for this.
Thank you, Anthony. So the real estate team focuses on 20% of the overall portfolio, moving into both traditional and niche property sectors, recently moving into data centers, cold storage, and gaming, to name a few. Our process really starts off with a macro trend analysis, and then we select a sector that would benefit from those, and we further select a security within that sector. And recently our analysis of population trends beyond the Sunbelt markets, as well as changing working from home preferences, has really indicated to us future pricing in both private and public real estate markets. And from there, we have also taken a renewed outlook on the office and apartment sectors, which we believe to be more underappreciated. And as well as we end with a security selection that is basically low financial leverage for all securities, shareholder-friendly management, and then more dynamic portfolio strategies and acquisitions than peers. And Ethan's going to introduce you to our most recent diversifier on the real estate team.
Thank you, Colette. Today I'll be pitching Postal Realty Trust. They're the only publicly traded REIT that specializes in acquiring, managing, and leasing out postal properties to the United States Postal Service. We feel this company is largely underappreciated by virtue of the fact that it's in a specific sector that is largely non-institutionalized. Though operational since 2004, the recent period from 2019 to the third quarter of 2021 has demonstrated their creative and aggressive acquisition strategy, growing their portfolio from 271 to 926 properties, which contributes to a 70% year-over-year average rental income growth since IPO. For more information on the financials and valuation, please visit the appendix. The postal industry as a whole is largely scattered. Most USPS post office owners are individual and family owners with long holding periods, a decade to century long. Postal's primary goal is to consolidate this fragmented property sector. Postal's two revenue streams are derived from 70% owned properties and 30% managed properties, with a total portfolio of 1,323 properties. Tenantry under the USPS has been strong, as they have had 100% rent collection since 2004, unsurprisingly, and their lease renewal rate has been at 98.5% for the last decade. They are spearheaded by their chairman of the board, Dr. Donahoe, who provides extensive industry experience from his previous roles as the 73rd U.S. Postmaster General and CEO of the USPS from 2010 to 2015. Also, the image displayed here shows the positive views that insiders have on the long-term growth potential of Postal. And with that, I'll pass it to Roman to discuss U.S. equities.
Thank you, Ethan. Top into our U.S. equities allocation, you guys can see that we are heavily overweight in industrials, followed by fairly even weightings in tech, financials, and utilities. We are overweight industrials because the team believes that we will be able to find those undervalued, unnoticed, and unique securities for the remainder of 2021 and 2022 in industrials. And we round out the allocation with healthcare and communication services, which hold our long-term winners that perform well in all economic conditions. Moving on to our strategy, it's very similar to what real estate and fixed income has went through already. We take a top-down look, starting at the macroeconomic trend analysis, where we look at monetary policy and things like that to narrow down our sector selection. Once we have a sector selected, we move on to security selection, where we're focusing on undervalued, unnoticed, and unique securities. With this process, we've been able to find this industrial company, C.H. Robinson, which we will be pitching for you today. They're a multimodal transportation and logistics solutions company, which operates in North America, as well as having a global forwarding segment that operates globally. To look at the industry, as I'm sure we all know, the logistics industry has been plagued by a shortage of dock workers as well as truck drivers. However, third-party logistics providers expect demand to uptick going into 2022, with 95% of third-party logistics providers like C.H. Robinson believing there will be a demand increase going into next year. Along with this, the end of the year brings peak season preparation with holidays, as well as the recent passing of the $1.2 trillion infrastructure bill by the Biden administration. Moving on to the growth and financial metrics of C.H. Robinson, their global forwarding segment has been huge to promoting their growth throughout this time of increasing costs, with 14% uptick in spot volume. However, although there's been increased costs, they have been able to push all the increased costs to their consumer while growing their margins at the same time. We can see proof of this in the Q3 earnings with all-time high quarterly revenue of over $6.2 billion, as well as all-time high year-over-year revenue growth in the third quarter of over 48%. Because of these reasons, we believe that C.H. Robinson will lead the way, along with their proprietary Navisphere platform that allows their customers to communicate up and down the supply chain and through language barriers. And with that, we'll move on to Payne for international equities.
Thanks so much, Ryan. In terms of international equities, our security selection process is very similar to that of U.S. equities. However, because we are looking at international markets, it's important to consider both all of the political, economic, as well as the currency risk associated with these respective regions. In international equities, we're split into developed and emerging markets. Our current strategy for emerging markets is to diversify out of securities with high correlation to China in order to mitigate the high amount of political risk associated with the region. With that, we're diversifying into developed markets and looking for opportunities to offer attractive long-term risk-adjusted returns. In terms of our allocation, we're heavily weighted into tech and also a little bit into healthcare. This is because we wanted to take advantage of the COVID recovery prospects. However, we are looking to deploy more capital and diversify into other sectors and industries. Our most recent diversifier is Pentair. This is a pure-play water company that's based in the UK, and they offer residential, commercial, and municipal water solutions. Going into business segments, I'd like to start with the IF&T segment, their industrial and flow technologies. This is a business segment which serves mostly municipalities and offers solutions in water infrastructure, as well as equipment and accessories. Their consumer solutions segment serves residential and commercial pool equipment, as well as integrated water systems, such as point of entry and point of use systems for commercial businesses, as well as residential homes. Moving forward, I'd like to highlight a couple of key factors about the company. The first thing I'd like to mention is the management team. They've been heavily focused on long-term accretive M&A solutions, and that's backed up by the company's very low debt-to-EBITDA ratio of 0.7x. The company is very well positioned to take advantage of any M&A opportunities that may arise in the future. Next, I'd like to highlight the backlog. They have a $1.6 billion backlog, which is a record for the company. And this backlog is going to help drive demand as well as boost their margin in the upcoming quarters. Lastly, I want to highlight that the company has consistently grown their top line as well as their business segments, and we believe that this is going to be great security for our international allocation. Thank you very much. The team would be very happy to take any of your questions.
I have a couple of questions. I'll start with one though. So on the REIT, the United States Postal Service REIT, so they're the only REIT out there right now that's doing this right now. Is there any barriers for other REITs doing it, or why are they the only ones?
They've just discovered this is a niche sector, and they've essentially been the first ones to pounce on the opportunity. There's a private sector that is beginning to develop as well, but they're not acquiring as many properties as Postal is. It seems a little bit more stagnant, so we're confident in the growth potential of Postal.
And then I have one more question too. On the allocations, when you look at the U.S. versus international, I know U.S. you heavily overweight industrials, and international it's almost all IT. Why the difference there, and why do you see industrials good for the U.S. and not outside the U.S.? Or why is there such vast differences?
So in terms of industrials and international, we saw a lot of different supply chain issues that arose. And we believe that at the current time, because this was around early pandemic to mid-pandemic, we believe that tech as well as healthcare were the best growth opportunities within the international market. But currently, we're still trying to deploy more capital into diversifying into maybe industrials and other industries and sectors for international.
As far as addressing the industrials allocation in U.S., the reason we are so heavily overweight in industrials is because, like we mentioned, there's a lot of opportunities that are going unnoticed in industrials, just because it's not inherently as an attractive of sector to retail investors as tech is. As we know, in U.S., tech has kind of led the way for the past year and through the pandemic. However, we believe, just going off our strategy, that finding those securities in the industrial sector that are undervalued and underappreciated maybe just because of the business models that may not be as attractive as tech, that's why we heavily weighted in US equities.
Great presentation, guys.
Wonderful presentation. I appreciate all the small things that sometimes go unnoticed, like the footnotes, and just adding context to some of the statements that you guys make. So I think really great job, and I think also a great job on the written report in regards to formatting and being concise and thorough with your responses. So thank you guys for that.
Thank you.
One thing I was well, first question should be pretty straightforward. What is the breakout of U.S. versus international? I saw in one part of the written response it was 37.5 to U.S. and then another place I saw 40%.
So the allocation as far as the US goes is around 37.5%. We just rounded up to the whole numbers for the ease of the presentation.
Okay.
But it actually is 37.5%, which
Okay.
we have in, I think it's one of the beginning slides that Nick discussed.
Perfect. That makes sense. And then I was a little surprised, and maybe it's because I'm from Minnesota where Medtronic is based, but that Medtronic was classified as international holding. So can you guys walk me through kind of the background as to why it would be considered international?
So our classifications are basically based on where the companies are headquartered in terms of tax residency. So although it might be, you know, a company that mostly operates within the U.S., we're really looking at where they're headquartered and where they pay their taxes.
Okay. So would you say then from an exposure perspective that you, like tax domicile, would consider that to be the most important characteristic of an underlying securities classification?
It's not the most specific, but just in terms of like how the group operates, this is sort of like the rules that we follow. But we do take into account the exposure to certain markets, even if, for instance, if a country is paying tax in Ireland, if they have 92% of their revenues generated in the US, we would consider it an international equity, but we do take into account the fact that most of their business is from the US.
And so for Medtronic, do we know what percentage of their revenue is generated in the US?
We don't have those numbers for Medtronic right now, but I can get back to you on that.
Okay, thank you. That's all I have right now, so you guys can share.
We have one question. Again, I'll reiterate what everyone else has said, a really great job getting down to the specifics, especially on the individual companies. Again, great job. One question I do have, that is an awfully high real estate allocation. Was wondering, is that a strategic, a tactical deployment? Is that what your thinking is, or what is your thinking on that? What is the justification for that?
Yeah. So we just see real estate as having a greater runway than a lot of other hot industries that are already kind of pricing in how hot they are. Real estate, we don't believe it has priced in everything yet. We have more opportunities in real estate to diversify into more niche sectors that are underinvested in, more areas where we can grow there. So it is more strategic, yes.
Are you referring then to the equity, whether it's domestic or international, as well as fixed income, or are you across all asset classes?
I was referring to real estate, but yes, it is across all as well.
Thank you.
Again, kudos to you guys, great presentation, really enjoyed it. It's always fun to hear. A couple questions in terms of allocation, and I did have a question about real estate, so thank you for answering that as well. In terms of fixed income, it's pretty high overweight to preferreds. Can you kind of walk me through that? Is there any concerns with preferreds correlations like the equity markets in general?
Yeah, great question. So our theory for fixed income as a whole is low duration, and with that comes high yield instruments. Preferreds obviously yield more than debt because their cost is higher. So this summer specifically, a lot of the financials, like they usually do, issue a lot of preferreds, really high coupon rates, again going towards low duration. So our theory of fixed income is inflation is our biggest risk right now. So how can we kind of smooth out our holdings during this time of inflation, as well as minimizing price risk? And although, yes, preferred securities are correlated to equities as a sense, they're under our fixed income umbrella.
Yeah.
So we do treat them as such in that regard, but we are very bullish on preferreds, especially the higher yield ones and newer issuances, as they, like our main strategy here is, they're overlooked in a lot of cases, and the yields are very attractive.
Okay, wonderful. On the U.S. side, with 50% of the equity, the U.S. equity exposure to industrials, what are some of your risk controls in terms of how you're sizing those individual names? Because I'd imagine if you have some concentration there, you might have some other concentration.
As far as industrials, just we want to diversify within the industrial sector just because of how high the allocation is.
Yeah.
And we've done that with whether we're looking into logistics companies or even we looked at companies such as engine producers for the semi-trucks, different things like that. So with such a high weighting, we want to focus on our diversification. And we've done that with companies like C.H. Robinson that has been overlooked and maybe not a huge well-known name in the industry, but they have that dominance that will be able to carry our returns in our portfolio. And along with the other sectors, we just want to stay diversified among the whole allocation with it being so high weight in industrial.
Is there a cap on how large a position an individual company can be that you have set?
We do have we usually don't like to go over a certain percentage in our portfolio. I'm not sure on the exact number.
It's
5%.
5%.
Yeah,
5%.
5%. Any new position we take on is around 1.5%, traditionally speaking.
Okay.
But kind of bouncing off for Roman, with C.H. Robinson specifically, even though industrials as a whole is overweight, we do have the individual securities we select are usually very low beta. C.H. Robinson has a beta of 0.6, also one of the highest ROEs among its peers. So we don't just add securities just to add beta to add return.
Yep.
We find low beta, want to generate that alpha, and our strategies work really well.
And just to add to that, industrials is one of the most widely defined sectors with 32 subsectors. So just because it's an industrials company doesn't mean it's really the stereotypical industrials company.
It also
There's
has
HR firms and
it
everything
also has
else
one of the
under
lowest price earnings ratios compared against other sectors currently in the market.
I can maybe ask one more question, just kind of high level, thinking about the portfolio's kind of position for more of an inflationary environment, risk on. What types of exposures in the portfolio do you feel will provide what we would call a ballast or kind of that risk off protection? Given that the fixed income is generally focused on yield and low duration, what happens if we have another downturn like we did in March 2020? What do you think the portfolio might look like?
Well, so like we kind of mentioned, we're moving into real estate, and that's largely because it's an inflation protection. Let's say we kind of head into a downturn, we would actually shift our allocation more toward net lease REITs. And the reason why is because they have basically protected rent. So we stay away from them when it comes to inflation, but if we head that direction, we'll shift into net lease.
As far as the U.S. equity section goes, that's also another reason why we're so overweight in industrials, is because a lot of the companies we are looking at, we're very sure in their capital stack and being able to take on a high inflationary environment and also possibly a market downturn, more so than many of the tech companies that are high growth right now. And along with Anthony mentioning the low beta of a lot of the industrials companies that we have in the portfolio, just a better protection compared to other sectors that have higher betas.
Yeah, and for fixed income, we're already at zero lower bounds. So if there were to be another downturn, there's already a liquidity issue at that point. So we'd also have to allocate to other asset classes, like the ones Colette mentioned, to help us provide that return.
You have like 20 seconds if someone has a last one.
You doing any EM or no? I just wasn't sure.
We are looking at opportunities in EM. Currently, we're looking at something like TSMC. I'm sure everyone's heard the story about them. So we are doing EM, but we're trying to make sure that our correlation with China is not super high in order to mitigate the political risk.
All right, thank you guys.
Thank you so much.
My name is Dimas Funes.
My name is Brandon Fajardo.
My name is Sean Su.
I'm Elizabeth Plaseka.
I'm Neo Shu.
And this is our presentation.
So a little bit about our school and our organization. We were established in 1970, around where the school was. And we started the Highlander Financial Group in 2014 with just a small team of 10 members. Since then, we've grown considerably to about 30 members. And through this growth, we established a new investment fund called Highlander's New Investment Fund, which was established in 2019, beginning with an endowment of $190,000, and its current value as of today is around $207,000. Right here, we have our structure
our organization. So we'll report to one managing director. The sector managers direct the direction of the research on equities, and they lead a team of analysts to help with the research.
So we are bottom up. We did bottom up approach. When we have our selected stock, we will continue. We will do the fundamental analysis to figure out the competitive advantage that it has. We will continue then with the DCF model, and then we will create a presentation as a stock pitch format for the HSIF group, and we'll go into Q&A to decide whether or not we choose that company.
Our investment philosophy is tilted towards growth. Although we will consider value investing if it is, if it seems like an attractive position. We focus on qualitative or quantitative, and then we focus on qualitative to see if the individual company is good to like its customers, its client, or retailers and other people who interact with it or other organizations.
All right, so we're going to start with the macroeconomic outlook. As said, we think that inflation is on the rise. So as you can see from the graph up here, from the U.S. Bureau of Labor Statistics, the CPI index took a small dip, and when COVID hit, that's highlighted in the gray section. And since then, it's grown considerably to levels way before COVID hit. And because of that, and because of the consumers' buying power, we believe that inflation will continue to be on the rise. And as stated before, right, inflation is still rising with the supply chain dipping. As you can see through the great part that once COVID hit, it took a small dip, and then now it's back to stable levels. But because of this, there's been a lot of workers demanding higher wages, and because of that, there's become labor strikes. And with the higher wages and more demand, there's going to be higher prices. So, yeah, and with those higher prices, we see them just considerably just going way up, way past levels of COVID, and that's why we believe that inflation still is going to continue to be on the rise. Yes, with inflation rising and just more about the Fed tapering and things like that, the target inflation is still going to be considered at 2% with the current inflation at 4%. Even with the Fed change in February, we believe that inflation is not transitory and it's going to continue to be on the rise, which is going to affect all the equities and fixed income decisions in our portfolio.
As a result of our view on the current inflationary period, we have a fixed income position of 20% and equity position of 80%. This is because we're trying to, I guess, hedge against the inflationary risk that can affect the fixed income position. And our benchmark is 70% Russell 3000 and 30% aggregate bond index. So we try to maintain similar holdings, or not holdings, but position to the benchmark, but we do deviate from it to try to overweight and underweight more profitable sectors if we do find that beneficial. Our U.S. equity outlook is positive for 2022. We believe that increased consumer expenditures as a result of ending of pandemic and new government infrastructure bills are going to create or allow for more capital inside the markets, and we believe that the sectors that are going to be beneficial from that are going to be healthcare, communications, consumer discretionary, and tech.
Right. As said before, right, that the macro economy is going to affect how our equities and our fixed income is allocated. Because of that, we believe that we're going to target 20% of our entire portfolio into fixed income. We believe that bonds are the way to go in this time of high inflation, and we believe that all the other securities out there are just not as good. We want to think about the long term, but we also want to hedge against the risk.
Because of that, we wanted to go more in depth on our bond selection. And so our targets are short intermediate duration, which is a 1 to 5 year duration, and targeting high yield and low expense ratio. This way, we can get high gains while also paying the low cost for each of these securities.
Our sector allocations, as you can see right here, are pretty similar to the Russell 3, and we actually change our sector allocation depending on if we find a position in our current portfolio that is no longer profitable or that we want to trim. So we go ahead and release that position from our portfolio, and if we try to do a stock pitch every week, or if there's a new position that is more profitable that we project would be a better position, we go ahead and reallocate the capital from the loser to the new position and overweight or underweight the sector depending on that.
In order to build our equity portfolio, we have a 5-step process. First, we determine our sector allocation, and then we run stock screeners for our desired industry or sector. With this, we are able to find growth opportunities within those sectors or industries. And then we perform our peer analysis of produced companies with that stock screener that we did run. And then we compare the industries on a fundamental basis. And then after this, we review our research, mainly done on CapIQ, to see if the selected equities that we selected are are going along with our investment philosophy. Okay, and then in order for our ETF strategy, we basically have a selection process of finding ETFs within industry sector of such section with strong risk-return ratio. We judge these performance with comparison to index and benchmark, and then we limited the number of actively managed ETFs due to higher ratios. So today we will be pitching Illumina. Illumina is a genomic research company. Mainly they focus on cancer research. Within this cancer research, they usually break down the DNA and RNA sequencing. So they mainly focus on service providers and manufacturing machines for analysis of genomic variations.
So Illumina has recently made 3 acquisitions, Grail costing $8 billion, and we believe Grail was a good acquisition for Illumina to make because it expanded it more in the UK cancer research market, and Bluebee was sold at an undisclosed or bought at an undisclosed price, and it allows for the better management of the large amount of data that they use. And Enancio, also undisclosed price, allows for the compression of huge data sets that are intrinsic with genomic sequencing. For example, an entire human genome that is sequenced takes up 200 gigabytes of data. So we believe that with the increase or projected growth of genomic sequencing over the next 10 to 15 year period, that these 3 acquisitions, or 2 specifically, Bluebee and Enancio, are going to lead to better cost reduction and increased profitability for Illumina.
Okay, this is the valuation method we use for Illumina, also for other equities we are trying to evaluate in this portfolio. So we use the DCF, and our parameters are revenue growth, EBIT margin, and tax rate. For each of these parameters, we'll have 3 cases: the best case, basis, and worst case. Compared with this and the historical financial statements, we can calculate or reasonably assumption for these future cash flows. And through all these assumptions, we also get a WACC from these financial statements, and we calculate the EBITDA multiplier for Illumina's and the ETF and the equities we are researching for the multiplier from the competitors. And use that, we came up with the implied equity value of $427, which is 13% upside of the current price. And also we came up with a best case of 44% and worst case 10% down. That is the price range we're going to offer to this equity. And the table to the website is sensitivity tables. That is the EBITDA multipliers and WACC, and each price to different combinations. So give us another approach for the price range.
Right here, our investment thesis. As mentioned earlier, there's going to be a huge growth of the genomic sequencing, and specifically within the genomic sequencing, Illumina's biggest business is screening. So they make the machines that conduct the sequencing, and they also sell the consumables. It's like petri dishes and other items that the machines need. So that's all part of the screening, as you can see right here. It's a 27% compounded growth rate over the next 15 years or 14 years. So we believe that with the strong growth and the recent acquisitions that help make Illumina a more efficient company, that it is a buy. We allocated 5% of the equity or of our portfolio to Illumina, and since it has a low beta, we believe that it doesn't offer or won't create risk to the portfolio as an addition.
And this is the risk measuring part of our portfolio. We use 4 measurements: information ratio, tracking error, beta, and correlations. Our aim is to keep the beta from 0.9 to 1.2, so that can keep tracking this, and a low error, tracking error, and a higher information ratio. That will give us a better understanding of the risk measurement of this portfolio and how we can outperform our benchmarks.
Right here you can see the list of our current holdings. 16 out of the 33 holdings have been positive so far. We have a fairly strict sell discipline, and as you can see, there are a few losers, but the reason why we haven't sold them is because their underlying fundamentals haven't changed. So we believe that in the future they will create a positive return, and that they are currently being impacted either by pessimist investors or just market fluctuations in general. And
yeah, so with our goal being to outperform the 70-30 blend, we have to monitor our portfolio daily. We do this by checking those risks that Neil spoke about. We also look at to see if there's any other competitors that are performing better, and checking if there's any investments that are over or underrepresented. Lastly, we also have a 30% stop loss in our portfolio. And this is our current portfolio as of today. Even with with us not monitoring the portfolio during the summer time frame, we still managed with a 14.89% return for our portfolio. Our benchmark was 25%. Currently we have cash at 0.06 and equity at 79%, fixed income at 20%.
thank you. For the Q&A.
First question, wondering about the benchmark. So in the report, you alluded to that the only benchmark that you're comparing against is the 70% Russell 3000, 30% Bloomberg Barclays aggregate. The policy benchmark includes non-US equities as well. So I'm wondering why that was excluded from your benchmark.
Yeah, so the reason why we don't have non-US equities is because we believe that that would expose us to a little more risk than we would want right now. So the high inflationary period is generally affecting, a lot of countries. So we believe that it would be safer to just focus on the universe of US securities, and
I guess my point is though, is you can exclude US securities from the portfolio, but your benchmark will always have non-US in it, because that's the policy benchmark. So you'll be, just like every other school, will be compared against the policy benchmark, which includes non-US equities. So I just want to make sure that was clear. And then I also, and within the written report, had read that you're concerned about rising rates or you're targeting shorter duration in anticipation of the rate hike, which makes sense. But then you also wrote in the report that you're not worried about rising rates, so which one is it?
Yes, so we're not really worried about the rising rates. We're more concerned about heading into higher risk, right? So as said earlier in our presentation, that we only want to stick with bonds. We only want to stick with bonds because, one, we want to hedge against risk, and it goes with our investment philosophy. All right, our investment philosophy is that we want to just grow long term, right? This fund is started at 190, or started at 190, it started at 190, and now started at 270. So we want to keep continuing that, right? That's why we selected bonds. And the short to intermediate duration, we targeted those because, right, with the rates rising, we don't think that the inflation is going to get too big, just because of how Powell and the Fed has been handling it. Yeah, and because of that, we just want to hedge against the long-term risk and just target short and intermediate.
Okay, I would make sure that message is a little bit more clear. I don't know if that's the best way to say it, but you can be concerned about rising rates and still hold bonds, absolutely. So I would be clear in the messaging as to what your immediate concerns are, and if you're concerned that rates might rise, you would reposition, because you have to hold fixed income, right? So you would reposition the fixed income portfolio to take advantage of rising rates even. So just make sure that you guys have thought through that. But those are my immediate questions.
I had a question on the equity selection. You're using the Russell 3000 as your benchmark, but I think I also read somewhere where you're excluding small cap stocks, which is embedded in the Russell 3000 index. So just wanted to get you to elaborate a little more on maybe why you feel large and mid cap stocks create or have a higher valuation moving forward than small caps at this point.
Yeah, so the reason why we excluded a small cap stock is because our board of directors for the program or at UCR specifically says that we're not able to go ahead and research small cap, so we have to limit that to large and middle.
Thank you.
I think when you guys look at equities, you start off with a screener, and then you narrow it down to there, and that gives you an initial screen. So what is embedded in your initial screen, and then what fundamentals do you look at after you have your screen equities?
Fundamentals to look at after the screen equity is basically from the Is that your question?
So I'm sorry, it's just probably the math. Sorry, what did you say?
I mean the fundamentals of looking
Yeah,
at our equity.
Yeah.
We basically make based on the factors.
I can ask one question.
I saw something about you're creating a proprietary portfolio tracker, and I think it was in the written. Can you just elaborate on that? I'm just curious.
Yeah, so we were originally, I think you mentioned the Tableau.
Yes.
Okay, so yeah, we were originally going to use Tableau, but that it didn't end up like working out. So
okay.
we're going to go ahead and work on that. It's very like time intensive, but we went ahead for the meantime and put it on Excel, and we just created some data visualizations on there. But we are going to work towards moving it to Tableau since it is a more efficient data tracker.
Thanks.
In the report, I think you mentioned that you would be seeking opportunistic investments, which I think we all are, so that makes sense. But you also stated that the portfolio deems cash to be an inappropriate investment. So usually, an opportunistic investor would be in a position to buy because they have cash. So I'm wondering, if you're out there looking for opportunities, how do you expect to buy them? What's your process then for transitioning out of a trade into a new trade?
Yeah, so the reason why, okay, so we think it would be better to hold the cash position in like ETF or something that actually gives a return. We try not to hold cash just because, you know, inflationary pressures drive that down. So we try to hold that somewhere else, somewhere that we can actually appreciate.
Also, just to add on that, I messed up my slide a little bit. It's been a while since I've done a presentation. But basically, we do with ETS, we want to target a specific industry or sector, which we see value in, and also that I feel like that exposes us a little bit to more broad exposure, basically. So that's a little bit.
What industries do you guys like most right now?
IT, energy, and then definitely healthcare, and then consumer discretionary goods as well.
When you said like, do you mean more on a bottom up or do you mean on a top down basis as well?
Our investment philosophy basically looks at companies first and then goes deeper into the sector and industry. So that's basically what we've been doing. Specifically with Illumina, we were looking at companies that I believe we saw this stock in an article or a book, I believe, and then we dug deeper into that stock, and we were seeing compared to the other healthcare stocks within that industry, basically which one was doing the best, and Illumina was definitely doing the best right now. Like we had mentioned, they basically they focus on cancer research with DNA sequencing and RNA sequencing to see any type of mutations between those the genes, basically. And then they also did a little bit of COVID as well. They were working with Moderna and Pfizer for those, and then basically seeking to see if there's any mutations within that COVID strand.
Why do you think you guys underperformed?
So I think definitely the biggest reason why we underperformed the benchmark was because not being able to actually manage during the summer in accordance with the board of directors from the ECR.
And so, would you say then next summer that you'll encounter the same issue?
I think we'd have to be more proactive going before the summer months, knowing what we have on cash or if it's long-term or short-term. Possibly having like a stop loss for one of those. Be more proactive before we hit the summer months.
Because that would be a requirement too of managing the assets, is that you manage them for the full calendar year. No other questions?
Nope.
Okay. Awesome. Thank you
Thank
guys.
you.
Appreciate
Thank
you. All right. To start off, I want to thank all of you for joining us here today to hear Fullerton's response to your request for proposal. Our goal for this presentation and subsequent Q&A is to show you why we are well suited to manage your capital for the upcoming calendar year. Our agenda for today consists of going over our organization and philosophy, our investment discipline, our economic analysis, fixed income and equity portfolios, and finally, a discussion of our blended portfolio performance. Now, to start off with our organization and philosophy, I first wanted to introduce you to our leadership team, many of which you will actually be meeting today. Our current leadership team is comprised of upper division business students who have experienced managing the fund in the spring, and many of which are also in our Titan Capital Management program as analysts. Our team is also mentored by our faculty advisors, Professor Ko and Professor Lucas, and we are extremely grateful for their dedication to helping advance the program each year. Our team is structured via a student-led hierarchical structure with equity and fixed income teams led by the president and vice president to facilitate both our dedicated Smif class and off-campus meetings. Now, our structure provides us with a multitude of advantages. The first of which is that having a dedicated Smif class gives a safe and open learning environment for new analysts to explore market concepts and analyze securities. This is bolstered by having experienced members in our organization who can mentor incoming analysts to apply the concepts they learn in class to actively manage the portfolio. We also have a multitude of leadership positions offered in our student hierarchical structure, allowing students to develop their leadership skills, ensuring the continuity of our investment practices across future Smif classes. I'll now pass it off to Shannon to discuss our investment philosophy.
Thank you, Jericho. So why do we believe in evidence-based decision-making? Evidence-based decision-making, it helps us to avoid emotional or irrational management of our portfolio and to capitalize to capitalize on opportunities when other investors are. Evidence-based decision-making is the foundation of our investment philosophy, and it goes hand in hand with our first core practice, fundamental analysis. While performing fundamental analysis, we gather and objectively analyze qualitative and quantitative information to ensure that we are investing in healthy companies with strong growth potential. Secondly, our active management, we remain as the second pillar for us to support our research and to implement our investment ideas. Lastly, our 1 to 3 time horizon that help us to mitigate our effects in short-term performances that does not relate to fundamental deterioration. Through these goals, we hope to achieve our funds goals of capitalize our appreciation in our equity portfolio and superior yields in our fixed income portfolio with our risk management risk. Through these goals, we hope to achieve your goals by providing the CFA's objective by providing the CFA scholarships. Now I'm going to pass it on to Ken, who's going to go over the stock selection process.
Thank you, Shannon. Our buy process starts with top-down analysis to determine opportunistic sectors and quantitative bottom-up analysis for individual security selection. Our sell process starts with monthly headline reviews of the positions within our portfolio. More information about these processes will be covered on later in the presentation and can also be found in the appendix of our written packet. No matter the recommendation of a written investment report, all must follow the same approval process before being submitted to the CFAOC. Analysts must receive preliminary approval from respective portfolio directors, and once preliminary approval is received, they may begin writing the report. Once they are complete with the report, it must be submitted for majority approval to the Smif leadership and faculty advisors. If the report is rejected, we offer students the opportunity to review and revise the report or move on to a different investment idea. If the report is approved, it is submitted to Mr. Jared Lopez and the investment committee for final review and opportunity to provide questions and answers. To be better stewards of the funds we manage on your behalf, we strive to manage the portfolio year-round. This includes over the summer and winter breaks. Our equity portfolio takes a stance of using highly limited use of equity mutual funds and equity ETFs. They will only be used in the event of one of our positions reaching a stop loss, and they will be used to prevent excess uninvested cash. These positions will be sold once our teams identify a new suitable direct position. Due to the size of our portfolio, active and passively managed fixed investment vehicles are permitted. Even though our teams cannot impact the holdings within these vehicles directly, our team does extensive research on the fund's managers, characteristics, and industry weighting to determine if they are going to provide a positive benefit to our portfolio. Now for our economic analysis presented by Michael and Ada.
Thank you, Ken. When we conduct our top-down approach, we like to get a sense of where we are in the current economy to determine how we'll position ourselves moving forward. First, we keep abreast with up-to-date reports and projections of leading and lagging indicators, some of which you have here on screen, followed with additional data in the appendix. Now, we understand that COVID case is not an exact indicator. However, because of its impact it's had on the economy, it is something we monitor closely. Next, we take considerable notice to broad economic factors that could signal changes in the market or offer opportunities in specific sectors. Such factors have been the recent passing of the infrastructure bill, the proposed spending plan, and persistent supply chain constraints. For international investing, our benchmark is currently at 20% exposure, whereas we are 40% underweight. With this in mind, we regularly assess different parts of the world and assess their economic health. IMF GDP projections coupled with news on foreign relations help give us perspective on where to seek opportunities outside of the US. And now, Ada will explain our economic outlook and how that ties into our target asset allocation.
Thank you. So, our target asset allocation is 80-20, which is based on our team's belief that we're still in the economic expansion phase, and we thereby see more opportunities in equity compared to fixed income. Some signs for continued economic growth is the increase in consumer confidence and spending, as well as increased U.S. household wealth. We decided to allocate only 20% into fixed income as we see risks such as supply chain disruptions, labor shortages, leading to higher inflation, ultimately resulting in higher interest rates, which is limiting our opportunities in fixed income. For our market analysis, we understand that some areas of the equity markets are currently highly valued. However, through our active management, we seek to identify inefficiencies in the market and capitalize on undervalued opportunities. Certain mid-cap companies, for example, have not rallied as much as large-cap companies year to date, offering some buying opportunities. I'll pass it on to Chris to discuss our fixed income portfolio.
So we begin with a top-down approach by analyzing the macroeconomic environment by looking at key indicators and any other relevant data. From there, we make our assessments and strategize to plan out our desired sector allocation, credit quality, and duration. Then, after filtering through a broad scope of bond funds and ETFs, we use comparable analysis to measure the risk-reward profile between the selected funds, and ultimately we select the fund that best suits our portfolio. And then our sell process begins at our weekly team meetings where we discuss any changes to our overall portfolio strategy, economic outlook, or any significant fundamental risk to any particular fund. And now I'll be passing it over to Jehu to discuss our sector rotation.
We use sources like FactSet and Morningstar to evaluate economic trends. Our plan is to increase our high yield and investment grade corporates, underweight treasuries and securitized, and decrease our non-US exposure. We believe that our sector allocation will allow us to avoid interest rate and extension risk as well as emerging market risk. Now, our current trades are to sell off our preferred position to fund two trades, which are going to be a mutual fund and a bank loan fund. Now I'll pass it to Luz, who's going to tell us a little bit more about these funds for trades.
Thank you, Jehu. To align the portfolio with our goals, we do have our analysts read potential funds prospectuses, fact sheets, and compare credit spreads to various fixed income sectors with their respective benchmark. In addition, we also look to our economic analysis and our benchmark to ensure that we stay within the desired duration range. Currently, our duration is relatively close to the benchmark. However, with our current plan to sell our preferred shares position, we will reduce our duration and maintain our lower credit quality. As we do expect interest rates to rise, we do prefer to maintain a moderately shorter duration to the U.S. Barclays Aggregate Index while stressing a moderately lower credit quality to capitalize on the improving economy. Now we have Tyler with our security selection.
Thank you, Liz. We run a comparable analysis after we locate attractive securities. In our comparable analysis, we look into factors such as SEC yield, standard deviation, and Sharpe ratio to determine volatility and performance metrics. If we look at this example, which is for our T. Rowe Price bank loan fund, you can see we opted to go with the T. Rowe Price fund because of its SEC yield and Sharpe ratios being higher than many of its competitors and having a very low standard deviation comparably. In terms of our sell process, in our weekly meetings, we go over fund performance and fund characteristics to determine if it still fits into our overall portfolio characteristics that we're looking for. In terms of our fixed income portfolio, we have continued our trend of outperforming the Barclay Aggregate. Currently, we have a differential of year to date of 302 basis points. I'm going to be handing over to Jay, who's going to be talking about the equity side.
Driven by data insights, Smif blends both top-down and bottom-up approaches. Firstly, the macroeconomic environment, trends, and forecasts are carefully evaluated to determine potential investment opportunities. Companies then are put through a rigorous screen, after which comparables and DCF analysis are performed. And companies are then carefully evaluated after the initial position is taken to monitor that the investment thesis is still intact. And more on our investment process, we have Alex.
Thank you, Johnny. So, to capture upside, we systematically evaluate all sectors for market opportunities based on macroeconomic factors such as inflation and employment rates. Recently, we went ahead and reallocated our capital from our ITA cell towards direct positions in healthcare and industrials. Prior to our, and that was based on positive industry trends. Prior to the infrastructure bill passing, we also saw opportunities for growth in maintenance and engineering catalysts, which led to us increasing the industrial sector weighting through buying MasTech. Now on to our buy-side process. We utilize a bottom-up analysis in selecting individual securities. Qualitative factors such as management expertise, litigation impacts, and ESG are supported by a thorough consolidated fundamental analysis and are key steps in this approach. We follow up with running a DCF model that estimates the company's intrinsic value and helps support our company's position in the portfolio. A full DCF and fundamental analysis are available in the appendix. Now I want to direct your attention to the bottom graph. This is a chart of the fundamental analysis of MasTech, our most recent industrial buy that outperformed its peers on the comparable analysis. MasTech is measured under profitability, valuation, and risk, utilizing metrics such as, but not limited to, ROE, price to earnings, and current ratio. Now I'll be passing it on to Connor, who will be discussing our sell side.
Thank you, Alex.
When first going over our sell process, we look over our month-to-date performance of our portfolio. Then we go over our leaders and laggards with each industry and look at each company. Then we look through industry trends and see if our current catalysts line up with our sell process. Then if we see any divergence in our thesis, any lagging opportunities, or any opportunities that we see are more advantageous, then we go and write the sell report. For example, we recently sold ITA, an aerospace and defense ETF that was showing lagging capabilities and also an unwanted exposure within our fund. And we used those funds to buy MasTech. I next want to go over a quick brief of our equity performance. Our year-to-date equity performance exceeded the benchmark by 599 basis points, and on a risk-adjusted basis, our portfolio exceeded the benchmark by 20 basis points. I do want to indicate that while our standard deviation was 2.62% over the benchmark, we achieved efficient returns as indicated with our information ratio of 1.26. Furthermore, as the risks appear to be balanced, we want to say that we are in the expansionary cycle. However, we are aware of other risks that are involved, such as inflationary supply chain. Now I want to pass it over to Nick to talk about our year-to-date performance.
I think you guys hit fine.
Well, thank you for hearing our response to your request for proposal. We'd like to begin the Q&A section.
Thank you guys. I thought you did a really nice job in both the written as well as the presentation. I think there was a lot of small details. Again, I mentioned earlier to another school that don't go unnoticed, so that was great, especially the pictures. I thought you guys did a nice job of incorporating past presidents. Obviously, a big part of how we critique this is thinking about continuity and transitions and retention, so that's really important, so thank you. And then I also really appreciated that in reading the written report, there was a lot of comments around a risk-aware lens, so making sure that you're balancing return with risk and being prudent in that manner. And then I also appreciated that you guys just threw up the ESG mark as well. But I'll let other people ask questions.
Yeah, maybe I'll start with that. So when you look at a security, you start bottom up, and then you say at the very end, you're kind of looking at ESG in there. What do you guys look at, and how do you think about ESG, and how do you fit that in the process?
Do you want me to take that first?
Okay.
Yeah, so I'll go ahead and take that. So I think very good process given our bottom-up analysis. I did mention that qualitative factors such as ESG are a really big requirement as well. Recently, we've been trying to factor it in more because I think a lot of the companies also utilize that we are looking at. Sometimes their scores are based on our FactSet research, may be concerning. So we want to go in deeper in terms of what is their historical trend, as well as have they improved their score in the past. We utilize how much they're impacting the environment as well. We definitely have a consolidated section where we do evaluate it thoroughly. Nick, do you want to add anything on to that?
Yeah, I know currently there are no ESG restrictions for the CFAOC, but given that most institutional investors or some large clients have ESG requirements, we want to at least prepare prospective asset managers, as we all are, to enter that market.
I have a question. So I saw your fixed income portfolio. It seems you have some exposure to the non-U.S. Assets. I'm just wondering so what kind of assets there are, and what kind of how do you manage those risks? They are not necessarily directly associated with the U.S. or the curve risk that you manage.
Yeah, so that one I think is a T-row emerging market one. We are looking at whether to decrease it just because it has a lot of exposure to, I think its top 2 exposures are Mexico and China, and we're seeing a lot of headline risk there. So we are trying to mitigate that. We plan to decrease it, but our first priority is to bring our duration down, and the correlation with the equity markets. So that's why we're focusing on the preferred right now, but we are looking at the emerging market one. We want to probably decrease it too. Does anybody want to add anything else?
On the equity side, can you expand a little bit more on the active decision to underweight non-US? What kind of went into that decision?
So when it comes to actually underweighting, we know the benchmark is 20% MSCI acting. We did get some exposure through Checkpoint because they are based in Israel, as well as Sempra Energy since they are based in Mexico, even though they are majority revenue comes from Mexico, even though they are headquartered in the US. It really has to do with our lack of understanding for some of the areas. And if we can't make a solid decision on what to invest in and understand the systematic risks that some of those countries are, or that some of these companies have in those countries, we don't feel that we can make a proper informed decision. Moving forward, it is ideal that we would get more exposure there. So definitely.
Okay. And maybe as a follow-up, in terms of thinking about attribution, I mean, congratulations for outperforming the benchmark on the equity side. Do you have a sense of how much of that came just because you're overweight U.S. and the U.S. markets have dominated significantly over at least the last 12 months versus stock selection?
Yes, during our monthly performance reports, we do look at the statistics. I don't necessarily know the exact ones off the top of my head, but as you're saying, we definitely do see that our asset allocation, heavier on equity, specifically heavier on domestic, is going to be a major factor, and that's why we are starting to look at international as well. Just as Nick said, right now we might not be too familiar with it, but we definitely want to start exploring it, getting out of our comfort zone, and looking at those opportunities as well.
Appreciate it.
On your bonds, you guys are a little shorter in duration than the Barclays right now, but pretty close. What range do you guys feel like you're comfortable with, and where do you want to get your duration to?
Yes.
So for our plans right now, we are pretty close to it, but after our expected trades to go through, we do want to be around 5.2, 5.3-ish, so 75 to 80% of the benchmark, just because we do expect interest rates risk to be a significant risk going forward. So we do plan to decrease our risk there.
I just want to add, we don't feel comfortable going farther than 30% over and 30% below, just because of if the market were to turn against us, that would be a large bet that would be against our favor.
All right, that's it, I guess. Thanks, guys.
Thank you.
Okay, thank you for having us here today. We are the Beach Investment Group from California State University of Long Beach, and we're excited to be here. So, this is our response to the request for proposal from the CFAOC. So let's start with our presentation overview. First, the team introduction, our portfolio performance, our portfolio composition, our economic outlook and asset allocation, our fixed income strategy, and our equity strategy. All right, so let's get introduced to our speakers today. So first, my name is Adam. I'll be joined by Duke, Christopher Walcott, Bridget England, and Christopher Bisorka. And hopefully during our presentation, our investment philosophies become evident. And with that, I'd like to pass it off to Duke.
Thank you, Adam. Let's go to performance. 2021 has been a tremendous year for Beach Investment Group's CFA OC portfolio. Year to date, we generated a return of 18% versus 14% for our benchmark. Our largest contributor return are our investment into value stock within sector like consumer discretionary, energy, and material. Our largely contributed to return were Russell 2000 Value ETF, consumer discretionary ETF, and commercial metal company, which returned 23%, 29%, and 70% respectively. Our return was slightly offset by loss in Alibaba and CMC Material, which lost around 25%. Overall, our return is reflective of our ability to recognize opportunity within the economy and capitalize. We plan to build upon the beautiful work laid down by our predecessors and make improvement along the way. Next, I will pass the presentation on to Chris Bisorka for portfolio composition.
Thank you. Our portfolio that beat the benchmark is comprised of largely equities, 80%, and 20% of fixed income allocation. Among those equities, we have a pretty large selection of ETFs. Our largest pick will be the Russell 2000 Value ETF, being 17% of our portfolio. We then have two sector ETFs, materials and consumer discretionary, and then a little bit of the Russell 3000 to balance everything out. Our largest individual securities are commercial metals and Microsoft. Our current equity style allocation is 50-50 between value securities and quality securities. Our best performers in the value category are commercial metals and Decker Outdoors, returning 73% and 48%. Our best performers for our quality securities will be Costco and Microsoft, returning about 45% each. I'm now going to give it over to Chris Walcott with Econ.
Thank you, Chris. So our economic outlook follows broad economic uncertainty over the last year, and I've got some metrics over here in our graphs. Our first one is our core CPI versus CPI, which have tracked significantly higher over the last year, reaching 4% and 5.4% respectively. Supply chain disruptions are also a major factor in our economic analysis, with container rates rising 300% and container volume up 24% from the last year. Looking at our GDP, the U.S. has seen some robust growth, largely driven by a 12% rise in PCE, personal consumption expenditure, during Q2 of 2021. While we believe that the U.S. has had faster than expected economic recovery, there is the specter of the coronavirus pandemic still lingering over capital markets. We believe that the U.S. has moved past peak virus pressures, but global markets are still facing these pressures to varying degrees. So for our capital market outlook, we decided to use a weighted risk scoring model to better encapsulate our outlook. All these risks are weighted in terms of severity and likelihood, and it's important to note that none of these risks are viewed in a vacuum. Each one of these risks is interrelated to some degree. The first of our weighted risks is our monetary policy. The Fed has indicated that the purchase taper timeline is expected in November, and we anticipate interest rates to rise within 2022. So this is a pretty significant risk for capital markets due to the historical quantitative easing measures. The last time the quantitative easing created a taper tantrum during the last QE measures, where equity markets sold off and bond markets crashed. So we believe that this deserves a top rank in our weighted risk scoring model. The second up here is our inflation. So we diverge from the Fed's transitory thesis. We believe that inflation is going to be longer term. The reasoning behind this is that we believe that the Fed tends to use more dovish verbiage in their reports in order to avoid capital market reactions. So our inflation picture, we don't anticipate inflation to reach normalization until 2023 or beyond. With our supply chain risk, supply chain is facing issues with port congestion, labor shortages, and elevated container pricing.
We believe that the supply chain domestically will begin to resolve within early 2022, but globally, we're looking at 2023 as our horizon. Each investment group also uses business cycle outlook from Fidelity Investments. Through this tool, we can conclude that the U.S. is past the peak of the mid-cycle, but still well within the mid-cycle. Through this tool, we also notice our consumer net worth, so the consumer balance sheet is incredibly healthy with increasing consumer net worth and the lowest debt service obligation to date. However, businesses are still facing some issues with increased backlogs and a poor inventory to sales ratio. So our capital market projections for the coming year, we utilize two models. The one on the left here is our sensitivity analysis that we've done in-house, and Bloomberg Intelligence regression model on the right. So our in-house sensitivity analysis is 5,083, and on the Bloomberg model, it's 4,972. So through our top-down data-driven analysis, we've determined a appropriate target sector allocation for the next year. We plan to overweight the financial sector, the energy sector, and particularly the transportation and logistics industry within the industrial sector as part of our risk mitigation strategy, while underweighting sectors with high input costs, including consumer discretionary, consumer staples, and materials. Through our economic analysis, we've determined that equity, that an 80% split with equity and a 20% allocation to fixed income is appropriate. We believe that there's more returns to be generated within the equity market. Additionally, fixed income is facing risks with rising interest rates and inflation causing negative real return for fixed income securities. And I'll be passing this on to Duco with our fixed income.
Okay, thank you, Chris. And let's go into fixed income. In the treasury market, we see the market pricing in at least one rate hike in late 2022 and early 2023. Our fixed income team projected 10-year yield to head around 1.7% in early 2022 and possibly test the 2% resistance level later in the year. In the corporate bond market, we see fundamentals improving across credit ratings. We are especially encouraged by improvement in credit fundamentals for BBB rate companies. So even with the tighter spread in years, we believe that factors like investor hunger for yield and an improving economy will continue to be supportive of corporate debt. Finally, if we go to our proposal for the fixed income portfolio, as a team, we strive to generate return equal or higher than that benchmark whilst reducing the risk. So after identifying risk in the bond market, we put together an appropriate combination of fixed income security that would generate healthy yield while significantly reduce volatility. We recommend heavy allocation into floating rate leverage loan, emerging market corporate debt, and short-term corporate debt. Our analysis suggests this mix of debt will drive outperformance while significantly reduce any risk imposed by the economy. Next, I will pass the presentation on to Richard England for our equity strategy.
Thank you, Duke. Going into our equity strategy, we used a stratified top-down approach with the goal of controlling risk while also seeking return opportunities within the stated risk factors. The way to control risk is through diversification, and the way that we will be doing that is adding style constraints on top of the sector and industry constraints already required by the IPS. A style is a category of stocks that has been found to provide outperformance, as well as providing greater return while giving greater opportunity for reducing that risk. Correlations across styles tend to be lower and more stable over time compared to sectors and industries, and so that's why we'll be incorporating them. So the way that we'll be putting them into the portfolio is by incorporating the style constraint with that sector and industry constraint to give the greater diversification. And then within the style constraints, we'll be conducting top-down analysis to find stocks that are consistent with that specific style and our economic outlook. So with that being said, our equity style split is 40% quality, 40% value, and 20% momentum. So within each equity security style, we will be conducting a top-down approach as well as a reliance on strong fundamentals. So the first security style is quality, which has high profitability and a strong dividend, as well as projected continued profitability into the future. Our second style is value, which has a low price to cash flow ratio, as well as an economic-driven value trigger. Our third style is momentum, which has outperformance over the past year over the Russell 3000, as well as growing profitability to justify that momentum. The way that we went about selecting our equities is through a 5-step process. Our first process is the economic forecast, which was run by our economic outlook team to identify what industry and sector we'd be entering into. Our second step was a Bloomberg screener, which was derived by our equity analysts, which was then refined in step 3 to filter out based on a more specific
screener. Step 4 was to then analyze the companies that we found and determine their ESG, the company overview, as well as an intrinsic value, which leads us to step 5, the security proposal. Now I'll be passing it off to Chris to go over that.
Thank you. Using that process outlined by Bridget previously, we came to a number of stocks to recommend for you guys today. We decided the best fit for the portfolio will be OneMain Financial. OneMain Financial is a consumer credit lender operating out of Indiana. They've been around since 1912, and they specify in the near prime and subprime market. Their mission statement, summarized in about a sentence, is to improve the financial well-being of Americans by providing access to loans that they can afford and they can understand. Some key quantitative metrics that we were looking at when we were going through OneMain were its operating margin, its return on equity, and its return on receivables, as well as its net interest margin. They're all very high compared to its peers. And some key macro players that we were looking at were the Consumer Confidence Index, credit card lines issued, and consumer bank demand. Those are all up with lower delinquency rates. OneMain Financial has the lowest delinquency rates out of its peers at about 2%. The next closest would be 4%. Onto its peers and the consumer lending industry as a whole, here are 2 graphs showing the the personal savings drawdown, indicating the healthy consumer and the strong balance sheets, and a graph showing the increased demand on banks. But what really caught our eye with OneMain Financial was how they handled themselves throughout the pandemic and how they're able to successfully pivot their business to become online. Started out, it was completely in person, both for closing their loans and for shopping around. At the pandemic, that hit and they needed to move on to online. They started to close their loans at about a 30% rate online during that. They also picked up Expedient's underwriting software and risk management software to better underwrite their loans. That cut down the process from 180 days down to 2 weeks, which is very good cut down. Later on in May, they acquired a firm, Trim Financial. It's a fintech financial health firm. It's essentially an app that collects all of your bills, all of your subscription services, and helps you budget yourself. I believe OneMain did that to help the consumer, help the credit of their customer, and really helps them afford those loans. For the valuation of OneMain, we decided to use a PE multiples model as well as a dividend discount model. We came to the valuation of about $80 a share. That's going to have 57% upside for us. We came to that conclusion based on the key economic drivers. We think that the key economic drivers will help pull us up to the higher, more bullish case for our valuation. I'm now going to give it back to Adam to close us off.
All right. Thank you, Chris. All right, so as we come to the end here, there's a bunch of reasons that we think we are different than our competition. But the 2 most important ones I see up here, one is diversity. We all can say what diversity and why is it important overall. Number 2 is legacy. Why is legacy important? Well, as we start out in the spring every year, our new candidates for the class, for the BIG, are put in their application, and they are then, if they are allowed to join the summer program is called the boot camp program. That is where the handshake that takes place between the previous year big class and the new incoming year starts to happen. Because of that, the transfer of information goes over. Any existing knowledge gets transferred. Then, into the next generation, the process starts. So at the beginning of the year, you see the new group come in once they've gone through their application process. Then an elected team is brought together, the executive team. The executive team then brings together an outline of different groups within the organization. That group within the organization, one that we'll talk about, is the CFA group. That group has oversight and gives reports to us on a regular weekly basis. Anything we find outside of that, if anything needs changes, it is brought before the entire team. The team then has a supermajority vote. This ensures control and a systematic reduction system that allows a better, cohesive overall for the portfolio. And with that, I'd like to remind you that 1, thank you very much for everybody's time here. Thank you to Fullerton. Thank you to the judges. And most of all, we want to remind you that this is not just a presentation, but this is an offer, and we would like to have your business. And most importantly, to solidify that and make that a more layered, trustworthy approach, we ask for your questions now so we can leave here today knowing that we've earned your position and spot together. Thank you.
Wonderful, thank you guys, I really appreciate that. Let's see. I like that you had a good approach to both quantitative and qualitative analysis in your security recommendation. I think sometimes I myself included get caught up in technicals and thinking about valuations and upside returns, so I appreciate kind of weaving in how they behave during COVID as well, because that's really important. And then I also wanted to mention, I think your team did an exceptional job on tying a macro thesis into how you select securities. I thought it was very clear, very easy to follow, and it definitely helped me understand your positioning from a portfolio perspective. So I think you guys did a good job at distilling that down. And I'll let others jump in for questions, but can you pull up slide 10? And I might come back with some questions. I just wanted to have that pulled up.
That's just good.
So you guys can jump in with questions.
You said slide 10?
Yeah. And is this the current portfolio composition or is this the proposed?
This is the current portfolio composition.
Got it. And do we have a slide of the proposed?
We have a slide for the fixed income proposal, and then our proposed security will be One Main Financial. We'd like to keep most of the current portfolio the same because the previous class did a pretty good job.
Got it. Okay, so even though it is the current composition, it's like most of it's the proposed as well.
Yes.
Okay, great. So if we go back to slide 10, then my question would be in regards to the meaningful exposure to, say, like the Russell 3000 and the Russell 2000 value.
Mm-hmm.
And then thinking about some of those individual securities you've selected, like Amazon, like Apple, Costco, Walmart, Visa, Berkshire, knowing that those are redundant from the sector composition, how are you guys really thinking about choosing individual securities that are different from your broad sector composition?
Due to the heavy weighting for Amazon, Berkshire, like large market caps move those ETFs, there is a lot of redundancy right now, but we hope to comb through it in the future with the next portfolio to kind of narrow down on some smaller cap securities, maybe some securities that aren't in those giant indexes, or at least have a smaller pull. So we plan on selling off some of the value ETF for One Main Financial.
Got it. So like, do you know, like for Russell 3000, for example, how much of Apple stock is in Russell 3000?
That's one of the top 10 holdings, and I think it probably pulls it the most. I want to say it has like a 10% weighting in the Russell 2000. I'm not
Just
too
something
sure.
to consider, because
Yeah.
the individual stocks are going to give you even greater exposure than you're getting in the ETF. But
Yeah.
Go ahead, anybody else?
So maybe staying on this slide, it doesn't look like there's a ton of international exposure. Just
No,
a
there's not.
sense on just maybe highlight why.
I want to add to that. So because international exposure, our team process is trying to attack as precisely as possible by country and by industry. If we cannot efficiently analyze the security or analyze the security, and we cannot buy them like in an efficient manner, we will not get exposure. But if we find opportunity that we can get exposure on, and we did our homework, and after it matched with like first economic analysis, we will consider allocation.
So say it's in the universe, but you just haven't identified opportunities.
In our report, from the macro side of things, we do see risk within our Asia, China. So China, India. China has the Evergrande situation. They're also seeing a rise in COVID rates, specifically Delta variant. India is facing some similar pressures as well. And then through the ASEAN, so the South Asia Pacific, we're seeing very low vaccination rates. We're seeing some more supply chain disruptions. And so it's within that area, it's a little bit, we're seeing significant risk. Looking at South America, we saw Brazil having that crop failure. We're seeing some issues from the lingering effects of Hurricane Ida. And so that is not, we're just seeing a lot of risks in there, so we really want to make sure that we're picking appropriate securities and for our risk mitigation strategy going forward.
Would you ever think of an ETF that is for non-emerging markets outside the U.S. then? Developed, most of the stuff you said was emerging China and all that.
Well, same goes with like Chris' economic view. We believe in the precise approach. So rather than like a non-emerging market, we would try to target country by country, because as we may all know, a different country having different policy when it comes to COVID reopening and their investment into to recover the economy. So if we find a country that's doing all the right thing, and we think that country's equity market is undervalued, we definitely will have allocation.
Looking at our AFEs, so Eurozone, Japan, etc. The U.S. is really leading the drive in economic recovery right now, in our opinion. We're seeing some issues in places like Germany, particularly with the supply chain disruptions and them being a landlocked country. And that kind of goes for some of those other Eurozone landlocked countries. Energy shortage because of those supply chain disruptions. So once again, we're seeing a lot of attractive U.S. equities, but we do have exposure to emerging markets within our fixed income portfolio. So yeah.
And that was going to be my next question. Why do you like fixed income in emerging markets?
Well, fixed income in the market, because for equity it's more volatile. For fixed income, our fixed income allocation, we think of it as play on spread, credit spread of the emerging market. So as they recover, even though they don't recover immediately, we still see spread in the emerging market versus the U.S. bond market tighten, and we find like that would offer stability when driving a little bit more yield for our portfolio.
What's the emerging market fixed income?
So that ETF is CEMB, so it's emerging market corporate debt.
And is it local currency or is it all U.S.
It's all U.S. dollar denominated. So we actually look at some local currency, and how those ETF are structured. They pay so like once a year, so we don't get like any cash flow for like a year, while leaving ourselves exposed to like currency risk. So that's why we didn't consider putting it in the portfolio.
So would it be fair to say, I know on page 8, not to be a dead horse, but you have a bit of macro that you begin on with international, domestic, but then you move over to quality, value, momentum. Would it be fair to say that you are looking heavily at bottom up? Your macros don't seem to match on fixed income versus your emerging. I believe it was page 8. You had kind of what he meant. Page 8 was the.
Okay, page 8 is this next. Outside page 8.
Oh shoot, that's the summary.
We do have slide
business cycle outlook. Business cycle outlook.
Yeah.
Is where you there you go on the top right. You had EM clearly up there, and then on your was it page 10, the one that Paisley mentioned? You had quite a bit more, I guess, diversified portfolio. Would it be fair to say that you're looking at quality, momentum that above your screener of macros, or can you explain the process? They don't seem to match.
Sorry for that. So for our fixed income holdings, we do start with that top-down economic approach, but we obviously start out with that first, and then we kind of set it up in a way that we don't want to be moving all the securities all the time. We don't really want to worry about that because fixed income is the hedge. So we did use that bottom-up or top-down analysis to identify the fixed income securities, and our main concern in the fixed income world was inflation and interest rate risk. So we heavily reduced our duration and maturities, and then we also went to a little bit of on the lower end of the credit spectrum because we believe that will outperform in the years to come.
And in addition, our fixed income portfolio is structured in a way. So our key risk for the fixed income portfolio is inflation and rising rate, as I mentioned by Chris. And we just look through like the fixed income universe to like find a way to still generate healthy yield while like reducing the volatility, because right now like even the treasury market is like extremely exposed to rising rate and keep going up and down. So can you go to the fixed income slide, please?
Yes. This one, or this one?
No, the proposal.
This one?
Yeah, proposal. We have a help, yeah, that one.
This one?
Yeah, 23.
23?
Yeah. And we have quite a large exposure to short-term corporate debt, so that brings down the duration. Emerging market corporate debt display and spread as mentioned before. But what interests us is floating rate leverage loan. So other team, we see them use preferred stock variable rate security. So we actually tried that before, and didn't turn out so well because even though they have offered a bunch of yield, it also added in a lot of volatility to the portfolio, which is we're not happy about because as fixed income manager, we try to provide stability to the portfolio.
That's time. Sorry. That's fine.
Thank you.
Thank
So, hello everybody. We'd like to thank you for giving us this opportunity to present our portfolio to you today. My name is Cameron, this is Victor, Sonika, Joy, and Jonas. And we're going to start off by telling you about our team. So in blue is our current team, we have 11 members. In green are the alumni and our faculty advisor, Professor Thomas Lita. Now, although there's only 5 of us up here today, the remainder is up with us. So we're going to start by talking, or before we get into our proposed portfolio, we're going to start by talking about the current holdings. BAM performance has been strong at 12.2%, but we're performing under the benchmark by a negative 1.7%. Now, this is due to 2 reasons. The first of which is our China allocation, which is separate from governance in the country. The second is our portfolio is equal weighted by sector, and the benchmark is market cap weighted. Now, the gap there is significant, but we're maintaining the strategy of equal weight in order to better manage the portfolio. For risk management, I'm sorry. An example of our overperforming stock is Excelis Technologies. It's a tech stock and it's had some very good momentum. An underperforming stock is Activision, which has fallen under some questionable governance, and that's led to weak financials. So let's talk about the proposed portfolio. On the left is the CFA benchmark, and on the right is our portfolio. You'll see that we expect higher returns, but somewhat similar risk profile. Victor is going to talk you through how we've gotten those results.
Now that we've gotten a glimpse of the proposed portfolio, let's move into how we constructed this portfolio. We begin with the investment philosophy, which is outlined on the screen. I would like to highlight that we are client-focused, conduct fundamental-based research, and we continuously manage our portfolios. Once the investment philosophy is set, we move into the construction process, starting with historical asset performance, macroeconomic outlook. This aids us in our portfolio optimization, which leads into our strategic asset allocation. From there, we utilize our fixed income and equity strategies. That includes our VARG strategy that we'll get into shortly. And then we finalize our security selection and move into portfolio management. So in portfolio management, BAM continuously manages the portfolios, rebalances as necessary, conducts risk control, and keeps the client informed through monthly and quarterly reports. So now let's dive a little bit further into the portfolio construction process, going step by step, starting with the historical data and economic outlook. On the screen we have 20-year and 5-year historical returns, as well as standard deviation. As you can see, for the equities, return has been higher, while standard deviation has been lower. We use historical data to help us with our relationship between the 5 indices, which aids us in our portfolio optimization. I'm going to hand it back to Cam so he can introduce us to the economic outlook.
So no economic conversation these days is complete without first discussing COVID. High vaccination rates and fiscal stimulus in the U.S. has supported strong growth, and the consensus projections reflect that. Now, we wanted to dig deeper into economics, so we took the GDP and broke it down by its main components, and we'll be talking about the 2 largest, consumer and business spend. So GDP historically has performed at about 2.25 points, but is projected to be above that in future years. So that leads us to believe that we're in the early mid-stage of the business cycle, giving us pretty general consistency with the consensus. However, where we differ is we believe that interest rates may be slightly higher. And this is going to be driven by higher wages due to a smaller labor pool. But we believe that because of research from the Federal Reserve Jackson Hole meeting, that income concentration should keep pressure on these rates. So to give a little bit more color into that labor shortage, research from the St. Louis Federal Reserve has indicated that there's a portion of the 5 million that are currently missing from jobs, that 40% of the 5 million that are missing from jobs may not return. And on top of this, the working age population has peaked in the US in 2018. This has led to a resulting demand for labor, which has increased wages. And because of that and supply chain bottlenecks, there's been a spike in inflation. So on the business front, PMI and SMI are strong, corporate profit margins are high, and the dollar has strengthened throughout 2021. This might provide some headwind to foreign profit margins for US businesses, but we don't believe those to be strong headwinds. In summary, COVID situation and the US is in solid recovery. Rates and inflation may exceed consensus, but income concentration should provide some downward pressure on those rates. And then what that means for our portfolio is that the US is an attractive place to invest. Equities are preferred fixed income. And we want to be aware of a rising rate environment. Now I'll pass it off to Saniko, who will discuss our international markets.
All right, so now that we've taken a look at our U.S. economic outlook, we're going to switch to international markets, starting with markets that we deem less attractive. Those two are India and Japan. With India, we've witnessed poor COVID-19 management, and we just don't believe that the government is reaching its economic potential. With Japan, they have an aging and shrinking population that causes two main factors: minimal growth in the economy and lack of consumer spending. Now we'll move into markets that we do feel are attractive, those being China, South Korea, and European Union. In all three of these markets, we have seen amazing COVID-19 response. Diving deeper into China, we see technology innovation and their economy becoming more and more digitalized. We know that the government has a lot of tech regulation going on, but we want to see the positive side of that as well, that they're using this to expand growth benefits to the broader population. With South Korea, they are a tech-driven country that benefits greatly from China's growth as they are a main exporter to that country. And with the European Union, we see solid growth that is expected to be faster than the US in 2022. Alongside that, we see strong fiscal and monetary support from their government. Given our historical analysis and our economic outlook, we're going to walk you through how does that equate to our strategic asset allocation, starting with our capital market outlook. So we used Demogen's S&P 500 DCF model to find an ERP of 5.24%. Then we use CAPM and YTM to find our asset classes expected return that you can see in the chart below. After that, we run an optimizer for three different scenarios: minimum standard deviation, max Sharpe ratio, and max returns. Although the standard deviations are different, we believe that is manageably reasonable. We choose to ignore the minimum standard deviation because it's too conservative for us, and ultimately we decided on the max return scenario as we believe that the risk is manageable relative to how much expected return we're making in that scenario. After that, we tactically adjust our allocations into our BAM allocation on the far right-hand corner that gives us a return of 6%. This is just a graphical representation of our allocations. On top of that, we moved 20% from domestic into our international markets because we believe that these economies have strong growth potential. Now that we've looked at our strategic asset allocation, I'm going to pass it off to Joy to talk about our domestic equity piece.
For our domestic equity strategy, we first analyze value versus growth and small cap versus large cap. For the small cap, value premium has returned and is strong. However, in the large cap, it reversed recently and gone negative because large cap growth has outperformed. And we think this is due to four factors. First, currently we're in a low interest rate environment. And number two, we think there was a recent structural shift to more virtual activities. And number three, we think this is a market psychology. There's lots of momentum investing in the growth sectors. And number four, we call this anomaly because value has delivered consistent growth in the history. However, growth has far exceeded its historical return. So we call this anomaly. And with that, we think value will reassert as we are expecting higher interest rates and less work from home, and the market psychology will shift. So with that, our strategy for domestic equity is value and reasonable growth. We prioritize value, but also we want growing businesses. So with our VARC strategy, it's also supported by a research paper. In a paper by Verdad, value is further defined into value and quality. And value is using GP to EV metric, and it's better to use in the first 2 stages of the business cycle. And our outlook is that we're currently in the early mid-stage of the business cycle. Therefore, we're going to use GP to EV in our metric. With our research, and we also have research by Fidelity to show our how different sectors perform in different stages of the business cycle. With the research and our economic outlook, here is our sector allocation. We strategically overweighted and underweighted several sectors, and for the sectors that are weighted 10% or less, we're using an ETF to represent that sector. With our strategy, here I will talk about our selection process. We first apply our VARC screener, and then we narrow our stocks down into using our BAM 13 analytical framework. And each analyst on the BAM team will do research on each company and conduct DCF and DGF model. At the end, each analyst will do a report, and as a class, will decide on the stocks. Here is our VARC screener. On the top of the screener, we are going to see more value metrics to prioritize value over growth, and we see the GP to EV metric here. Towards the end of the screener, we see some growth metrics to capture some growth. And here is our BAM 13. It is shown similar to prior years. However, this year, we added another metric, days of inventory on hand, due to the current supply chain issue. We wanted to see the supply chain condition for each company. So in our BAM 13, we want companies that have grown and are expected to grow in the future, and they have efficient management. So now I will pass it on to Jonas to give us an example of a stock that came out of this process.
Hi everyone. I'd like to introduce you all to BorgWarner, an automotive parts manufacturer who we believe is primed to take advantage of the electrification of the automotive industry. At BAM, we view BorgWarner as a positive investment opportunity because first, they perform well historically. Second, they're recently valued at a P ratio of 10. 3, we're strategically positioned to take advantage of the electrification of the automotive industry. And 4, our DCF valuation of $67 gives us an upside over the current trading price. Because of these factors, we consider BorgWarner to be a good value play with good growth in its future, and a great example of our VARC strategy. Here are some of the assumptions that we made for our DCF valuation. We want to highlight our somewhat conservative cost of equity of 9.5. That was an example of one of our equity selection in our portfolio. Now let's move on to our international equity selection process. So, as mentioned prior, we allotted 20% of our portfolio into international markets. We further split that up into 10% in China, 2.5% in South Korea, and 7.5% into the EU. For these markets, we chose broad funds as opposed to individual securities. And to analyze these funds, we used metrics such as tracking error, Sharpe ratio, and expense ratio, among the others you can see on the screen. Individually in each of these markets, in China, we wanted to avoid state-owned companies. I'll talk a bit more about that on the next slide. In South Korea, we wanted broad market exposure. In the EU, we wanted developed-only EU, not developing. You can see some of the metrics for these funds on the side, all reasonably valued with good growth projections. So CXSE was our China fund selection. We chose CXSE because it gave us an ability to avoid state-owned companies. We don't like state-owned companies in China because they tend to be highly politically influenced, have low transparency, and are less profit-driven. Also, we like that it gave us more exposure to infotech and less exposure to real estate. While we do understand that in the short term, regulatory pressures have made infotech a painful sector within China, in the long term, we reassert that infotech and technology will drive the long-term digitalization and long-term growth of China's economy. That was our 80% of our selection, our portfolio in equities. Let me now talk about the remaining 20% in fixed income. Our outlook is informed by 4 current realities. First, historically low yields. Also, our outlook of a strong economy and rising inflation, leading to our outlook of rising rates, which we believe implies a high risk within the fixed income markets heading towards the future. And lastly, we want to reiterate that how we believe that rates will increase. However, this rise will be limited due to downward pressure from income concentration. These 4 realities informed our 3 goals within fixed income.
preservation of capital, protection against economic downturn, and generation of income with manageable risk. Our final selection allowed us to achieve these three goals. Half of our selection was put into intermediate treasuries, which we like because of their moderation, giving us moderate protection against economic downturn. The other half was allotted to a senior loan fund, which we like because of their floating rate characteristics and because their senior position within the capital structure. That was our entire process. For the end result, I'll hand it back over to Cam.
So here's a brief look at our portfolio breakdown with the tree map. And tying together everything that we've talked about, here's our recommendation. We believe we can return 6%. This is above the CFA benchmark, but with a similar risk profile, without taking much more excessive risk than the benchmark. So we want to acknowledge that 8% was the goal of the CFA RFP. However, achieving this would have required that we take on a lot more risk, specifically in equities. And we don't want to recommend that at this point. So we've discussed a lot of numbers, and we'd like to take it down to one simple question, which is why choose us? Now, that's because we put you... Okay. No worries. Thank you.
Thank you. Thank you guys. I really appreciate some of the unique ways that you approach security selection. Your BAM 13 model, I think, is always well received, so thank you for that. And also, too, nice touch of talking about past members and including those and such. Question for you. I feel as though you guys are presenting an active approach, and then when I look at your equity allocation, it looks very benchmark tethered. So I know you mentioned being over underweight certain sectors. For the most part, I would say you're benchmark neutral. Most of the sectors were within 1% of each other. And then on top of it, 7 of the 11 sectors hold ETFs, which is a pure passive approach. So if we take a step back and really think, do you really believe that this is an active approach to equities? Because if we look at the positioning, it looks like it deviates a little bit from the thorough process that you went through of how do you select securities and the valuation model that you use, but really you're just using ETFs and most of them are the same weights as the benchmark.
Yeah, thank you, Paisley. That's a very good question. We do want to remind you that 60% of our equity allocation is made up of individual securities, so we do try to be very active on that front. And out of those ETFs that we've selected, we're diversifying among 7 of those between sectors. So that's how we try to capture the broader market within the equity selection.
Just a question, sorry, looking at the capital market outlook, I mean, it's ever so slightly, but you do have a higher expected return for developed markets versus EM. But then in your proposal, you have a higher allocation towards EM than developed. Just wanted to get your thought on it.
So we do acknowledge the return that is higher in the developed markets. However, we allocated more in the emerging market because we really like their economic outlook. We conducted economic outlook analysis in the emerging markets. And we see particularly in China, although we acknowledge the recent tech crackdowns and regulatory pressure, we still see potential because right now they're trading at a relatively low PE ratio, and we think we can take advantage of that. On top of that, we think they're in the beginning of their tech innovation, so we think there are lots of potentials in there. And even though government is putting a lot of pressure, they're not really killing the companies. We do have example in the RFP, Alibaba, their punishment and versus the real market cap. So we see a lot of potential. And for South Korea, it's a huge exporter to China, and if China is growing, we're thinking South Korea is also a very good opportunity for us to invest in. Yeah.
My question is for equities in general. You mentioned, for instance, roughly 2/3 of the domestic is active, it will be actively managed. And on the emerging side as well, very different, very heavy EM allocation versus the benchmark. How will you size your positions, or how will you track an error to ensure that to ensure if changes need to be made? How will you make those decisions in light of such heavy domestic and international allocation?
can you restate that question, please?
Because of the very heavy allocation towards emerging market and I'll leave it to the international, how will you ensure or make changes if the tracking error is very different from the benchmark? Obviously on the downside, but that's why I asked the domestic as well. I'll leave it up to you how you want to answer that.
So for our international allocation for all the ETFs, we do have our self-discipline listed in our PSL as monthly 50% stop loss, and for domestic equity, I think it's 30% stop loss.
I actually hold CXSE in my personal account. However, I think that a 10% allocation in the portfolio might be a little bit lofty. So I think kind of alluding maybe to Will's comments and thinking about risk mitigation and portfolio positions and such. It's a fairly concentrated, I know it's a diversified ETF for sure, but just thought that wasn't a question, by the way, that was just spewing my thoughts. But again, I do hold it in my personal account.
Well, mine was a question, but it may be not very well stated. It's just really, as Paisley mentioned, the market is very heavily a developed market. If you don't hit those 50 or 30% tracking errors on the domestic side as well too, you have the potential to deviate very heavily without ever hitting that. Do you have any parameters for that?
Yeah, can you go ahead and restate that for us one more time?
Do you have any parameters for heavy deviation from your benchmark in light of your international exposure?
Yes. I think you're referring to tracking error. What we do is when we're looking at the ETFs, we compare tracking error amongst the peers. And the one that was more resembling the benchmark is one that we prefer to use. So we do look at tracking error, and we do ensure that we use the one that's more related to the benchmark than the others. Did that answer your question?
So yes.
Okay.
Yeah, I saw you allocate like the 7 to 10 year treasuries. Is that, what's the target duration of that? Because you mentioned the rising interest is a risk, but that's the duration looks pretty long to me. And what's the other the 10% of the target, like the duration of the other 10% of the SL?
Yeah, so I can go ahead and answer that one. So basically, the duration, if you want to know, for the intermediate treasury is 4.5. We had a few goals that we ended up going for in our fixed income. And one of those was protection against economic downturn. And while we do understand that it does give us some duration exposure, we wanted to have protection against unlikely, we did want to have a hedge against our equities portfolio. And we put that into intermediate treasuries.
So do you think the economic downturn is more imminent than the rising interest rate, or they come together?
We don't think it's more likely. However, given our strong allocation into equities, we felt that a higher allocation to our fixed income portfolio and to more risky fixed income assets would needlessly increase the risk in our portfolio.
Thank you.
This is more professional curiosity. For your optimizer, what are you using for that? What are you doing it for?
For the optimizer, we use Excel. We build models, and from there we get the. It's just a lot of matrix division and multiplication. From the optimizer, we use ERP, and then we get our CAPM. We use a CAPM to put into our returns, and from there we run different scenarios based on minimum standard deviation, max Sharpe ratio, and max return. So yeah, the optimizer is done on Excel.
That's actually, I was going to ask that question too, because my follow-up question to that was going to be, in the written report, you stated that you strive to maximize risk-adjusted returns, and then you walk through how you use the optimizer to select the portfolio, reduce the one that mitigated risk because of obvious reasons, and then when left with the choice between the max return and the max risk-adjusted return, you chose the max return. So I'm wondering how that ties out to you guys with the focus, saying that you strive for risk-adjusted, but then you sought the max return. So
yeah, that ties into our fixed income outlook. In the max Sharpe ratio, we have higher allocation towards fixed income. And with the minor changes that have occurred in fixed income, we've seen major volatility, which raises this standard deviation while producing less return than the max return. So we decided to go with max return to reduce our allocation to fixed income, and from there make tactical adjustments based off of our economic outlooks.
Any other questions? No? All right, thank you. All right, thank you everyone so much. I'm sure you're all quite relieved. I know how stressful it is, how much work has gone into it. So the good news is we have some snacks and some drinks back in the reception room where we started lunch earlier today. We don't have a bartender this year, so it's going to be the honor system. And so everybody can make sure that it's the buddy system.
If you're this high or taller, you could drink. Okay?
Yeah. If someone's under 21 and I catch you drinking, it's not going to be pretty, so I don't know, but you all know each other. So if the professors and advisors could help out as well, that was my PSA statement, so thank you. But I do really want to say thank you guys. I would say, even though we say this every year, I actually felt this year that the caliber of presentations, and I probably spent more time reading the written reports this year than I have in the past, and I was so impressed. The way that you guys articulate your investment thesis and the way that you guys propose your allocations and how you guys work together as a team, and I think that really came through this year, and I thought everyone did a really remarkable job. And then
I think we saw the president of CFAOC walk in, wasn't it?
Yes, Derek. Derek's here as well.
Stand up, Derek, come on.
Sorry.
He's having a good hair day today.
Yeah. Sorry I came in so late. I'm excited to watch the videos later.
And so Derek is the current president of the CFA Society of Orange County. So thank you, Derek. I don't have my glasses on.
He's our VP.
Yeah. So Derek's on the board, I'm on the board, Fidel's on the board, Chad's on the board. So if you guys are interested in getting involved in the CFA Society more broadly, we have a student membership. We're always looking for young, eager people to come help from a volunteer perspective. I know that many of you already have or will be involved soon. So thank you. I just wanted to come